Hola a todos, gracias por sumarse. Estamos esperando unos minutos más para que se sume más gente y partimos en unos 2 minutos más. Así que empezamos de inmediato. Muchas gracias. Bueno, muchas gracias por la paciencia. Vamos a comenzar. Primero a todo, muchas gracias por sumarse y bienvenidos a este webinar sobre inteligencia artificial. Estamos con CF Private Equity, quizás varios lo conocen como Common Fund. Tenemos clientes que han invertido con ellos hace un tiempo. Vamos a dejar después más adelante que ellos hagan la introducción de la firma, pero tenemos varios años de relación con BICE y estamos bien contentos de esta oportunidad. Principalmente porque inteligencia artificial es un concepto que probablemente todos han escuchado, pero que creemos que hace mucho sentido aterrizar un poco y también entender en la práctica dónde están las oportunidades de inversión. Sin más preámbulos, dejo a Daniel Baleiro, que es Associate Director del equipo de Investor Relations in Common Fund, perdón, CF Private Equity. I will switch to English also for the benefit of our presenters. Daniel will give the introduction or our presenters on the firm. And please, Daniel, I'll give you the mic.
Sure, absolutely. Thank you so much, Alvaro, and thank you so much to everyone for joining today. As Alvaro mentioned, CF Private Equity or Common Fund, as many of you know us, have been working together for quite some time, and we are very thankful for the Chilean clients that we do have and for the opportunity to present to you today. So CF Private Equity has been dedicated to the private markets now for 35 years. So since 1988, that's been our exclusive focus. We have 5 global offices. I'm here in our Wilton, Connecticut office today, along with Cameron, and Dave is in our New York office. We have investment offices in San Francisco, London, and Beijing. Since our inception, we've raised $23 billion in committed capital from our investors across 93 partnerships. We focus on global private equity buyouts, early stage venture capital, and environmentally sustainable private equity. We also have a dedicated secondaries practice. Today, as Alvaro mentioned, we'll be focusing on the artificial intelligence venture opportunity. We believe AI is the next innovation wave, and we're very excited about the ways in which we believe our venture program is poised to take advantage of this next seismic shift in technology. So I am joined by 2 of my investment colleagues, Dave Shaker and Cameron Zarzi, on the venture capital team. They work closely on all aspects of our venture capital program, and I'm happy to turn the mic over to get to the meat of the presentation today to talk about the AI and venture capital opportunity.
Great, thank you, Danielle. It's a pleasure to be here. Nice to see everyone. We'll go through some prepared remarks on the AI opportunity, and then a little bit on the venture market environment, and then what we're doing in our most recent funds that we are raising and starting to commit, and we'll talk about the progress there, and then we'll leave some time for questions at the end if there are any. So going into the artificial intelligence opportunity, it's a question that we get very frequently. I'm sure it's on the top of most people's minds, given all of the progress in AI, generative AI, what it all means. So what we're hoping to accomplish with this section is to explain what it is, And then I think the most important question is where is the value going to accrue in the space, and what does it mean as a private investor? How do you capture that economic value and generate outsized returns? So if you look at artificial intelligence, it clearly it's become the forefront of the startup ecosystem, where most founders are spending their time building new companies. So what we're showing here is, it's called a word cloud. So essentially, it took the business descriptions from Y Combinator, which is the preeminent startup accelerator, kind of like the Harvard for startups, going through the program. And it looked at some keywords in those descriptions, and which ones show up the most frequently end up being the biggest words in the word cloud. And you can see that clearly artificial intelligence and AI stand out above the rest in terms of where founders are spending their time, some of the top founders where they're spending their time. If you looked at it a couple of years ago, you'd see the biggest words in the word cloud were fintech or B2B, business to business software. So there's been a shift in terms of what founders are really working on. And then we think that is where most of the economic growth will come from in the startup ecosystem. If you look at the potential of AI, it's clearly recognized by a number of important companies and important individuals. So we have a few quotes here. One from Jensen Huang, who's the CEO of NVIDIA, which is the maker of chips, GPU chips that are essentially the base layer powering a lot of AI technology today. Calling it the single most significant platform transition in computing history. So pretty big words there. And then another thing that we think is interesting is it's not just the technology industry phenomenon. So we have a quote from Jamie Dimon, the CEO of JP Morgan, saying that AI could be as revolutionary as the printing press, steam engine, electricity, computing, and the internet. So if you think about the value and potential of this market, it's some of the biggest that we've ever seen. And then one thing I think is important to keep in mind is this last quote on the bottom from Bill Gates, who says, people overestimate the change that will occur in 2 years, but underestimate the change that will occur in the next 10. And we think AI is going to drive those significant changes over the next decade. And if you look at how this has happened in the past, we see a lot of pattern recognition in the venture industry. There are platform shifts that have spurred growth over and over again. Each platform shift kind of corresponds to a different decade. So if you start all the way at the bottom here in the semiconductor space, Intel, which is a large established company now, obviously started on kind of the platform shift into semiconductors. And then if you fast forward and look at the 90s and the internet boom, dawn of the internet, you saw some winners and losers, but some emerging and then established companies like Amazon and Google, which are two of the most valuable companies today, were started at that time and took venture money and ended up growing and being successful exits. And then you saw the same thing play out again with the rise of cloud computing. So AWS, Amazon made a big play in that space on the infrastructure side. So did Google, so did Microsoft. But you also saw some applications built on top of that, like Salesforce, which is obviously an established brand today. Same story, was a startup at the time and ended up growing and accruing a lot of value. And then you saw the same thing again in 10, 15 years ago with the rise of the iPhone, the ecosystem built around the applications for the iPhone. And then you saw companies like Airbnb and Uber, which were founded a couple of years after the iPhone came out, but ended up being the largest exits over the next 10 years from the startup world. So we think a similar shift will happen with artificial intelligence. It's still very early, as you can see. Really came to the forefront with OpenAI and ChatGPT, which we'll talk about in more detail. But that's the infrastructure. But we expect this to happen again, where there will be a lot of applications built on top of it that will end up being big venture outcomes, which is what gets us excited. And so if we look at ChatGPT as a case study, ChatGPT isn't the entire AI space, but it is an example of how rapid the space can develop. So what we're showing on the left side of the page here is the time to reach 100 million active users, which is a threshold for pretty significant scale. And you can see ChatGPT there overlaid against Instagram, Facebook, Spotify, and X, which is formerly Twitter. And you can see that the explosive growth really stands out for ChatGPT. It reached 100 million users in about 2 months or so. The next most viral, most popular application, Instagram, reached the 100 million users threshold in about 2 years, a little over 2 years. So it's roughly 10 times more viral in terms of the user growth. And then the other piece to keep in mind on the right is that it's still very early in this development cycle. So if you look at ChatGPT searches using that tool versus on Google searches, you can see that's not even close. ChatGPT has about 2 billion monthly searches. Google has 272 billion monthly searches. So ChatGPT, even though it has grown pretty quickly right out of the launch, is still less than 1% of the search market. And if you look at Alphabet's market cap of about 2 trillion, part of that is their cloud business and some other things, but search is still the vast majority of the value ascribed to Alphabet. So you can think about that space, a trillion and a half type of market cap, roughly that ChatGPT is going after, and has a small sliver today, but you can see how that could be a very big business in and of itself. And then the other piece that people ask about is, what about the monetization or path to generating revenue for these companies? Obviously, there's a lot of people talking about AI, but what does it mean in terms of dollars? And you can see here that revenue has come very quickly as well. So similar story in terms of the exponential growth and potential of this category. So what we're showing here is aggregate revenue for the AI industry versus aggregate revenue for SaaS, which is software as a service, so cloud software. And you can see that AI reached 3 billion aggregate revenue today, and it took about a little over a year, maybe 2 years to get there. And if you look at the SaaS line, aggregate cloud revenue took about 10 years to reach that same level of scale. So this is moving very quickly, but again, it's important to underscore that we're still early, and the economic impact could be massive.
Great. And while we're still early, we looked at a bunch of different sources, and I think it's clear that there's a big opportunity set. So, if you look on the page, we have a number of different reports from large institutions like JP Morgan, Goldman Sachs, and PwC, with some of these reports suggesting that AI and this technology platform shift could contribute up to $15 trillion to our GDP over the next, call it 5 years. And a lot of that's coming from both productivity and other kind of consumption side effects. But it's clear that this technology vastly expands what software can do. And you're seeing companies that adopt AI capabilities able to drive, significant usage and revenue, like Dave shared on some of the prior pages. If you look at what that translates to in terms of kind of impact, right, you're seeing a reduction of the cost of goods sold. So companies can, implement a customer service chatbot rather than hire an army of individuals to handle that. You're seeing accelerated R&D processes where companies are able to ship products faster. And then you're also seeing net new products emerge. One example is, Figma's working on a text to design tool where, eventually we won't even have to pull this PowerPoint together. We could just type out what we want and it could generate that for us. So, these technologies are really augmenting the modern workforce. They're leading to, workflow automation, time savings, cost reductions, and also making our workforce smarter by making info retrieval faster. So if you go to the next page, an example of that kind of productivity, benefit is, we asked Perplexity, which is an AI chatbot that provides kind of sources and cites links, that same question of how much value is AI expected to contribute to the economy in the coming years. And Perplexity came up with the same answer in seconds, whereas it probably took us an hour to research and pull together all those articles. So I think that's one major benefit in terms of productivity and kind of an easy and clear example. I think another piece of this too is, these AI systems and the software capturing more of the services economy. So, as a personal example for that, my fiance runs an e-commerce business, and then at the end of every year, we have to go and do our taxes, and it's very manual. We have to poke through all of the reports and figure out what we want to, which expenses should be write-offs. And historically, how we've done that is we've had to find an accountant, message them, ask, what am I able to write off? Instead, today we're using an app called Keeper Tax, where if I ask, what percentage of my rent am I able to write off as a home office expense, it can give me that answer in seconds. So I think these are a couple simple examples of kind of AI and the benefits, in action today. If you go to the next page, Dave, if you looked at prior platform shifts like cloud and mobile, there were a lot of billion-dollar companies that were formed, but this was after the infrastructure was built out. So for cloud, for example, you needed Amazon to build AWS and Microsoft for Azure and Google's platform before you could ultimately start to see, the adjacent categories such as the tooling and the apps, which ultimately are what, the consumers are interfacing with. And then if you look on the right side, we're showing where we are in that with AI today. There's a lot of white space here, and all of these companies are just starting to be formed now, and we're just starting to kind of imagine what's possible with these new technologies emerging. If you think about the AI tech stack, at the very bottom you have kind of the data centers, the hardware providers like NVIDIA, which provide the GPUs to help run the models, and then above that you have the cloud platform. So this is infrastructure that was built out in prior cycles. So we're building on top of other technology platform shifts. On top of that, you have the AI models, and then ultimately the apps, which are what the end consumer ultimately interacts with. So, if you look at the opportunity set, right, there's opportunity within tooling. So how do you decide which of these models and which data sets you want to use to effectively address a certain use case? And in terms of applications, there's a lot of potential runway here in terms of what's possible. And I think a lot of people forget too that AI, this didn't just emerge overnight. It's really been the progress that people have seen that has led to this spark. So if you looked back 10 years ago, I think these AI systems, they wouldn't be able to tell the difference between, a dog and a blueberry muffin. And today they're able to score in the 90th percentile, on the bar exam. So we've gone through a number of different phases where, in the 2010s, you had predictive, where Google could potentially finish what you were writing. And then in the 2010s, you had identification. So you can, facial recognition, you could unlock your iPhone. You had autonomous vehicles became possible. And now we're moving into this era of generative AI, where for the first time computers can be creative. And I think the hope is that we move from this predictive and identification and generative AI to full autopilot, where these AI systems are able to form hypotheses, are able to handle human level reasoning, and take action on your behalf, whether that be make bank transactions or call people on your behalf. So ultimately, we're hoping to see that these systems move from kind of co-pilot to co-worker, and there should be a lot of different applications that emerge on the back of that.
Yeah, I wanted to underscore a couple more things on this page. So this is the technology stack, and it's sort of in vertical order when you look at the page. So infra, which is infrastructure on the very bottom, is kind of the foundational infrastructure that's needed to support the things on top of it. And so what we've seen in past cycles, cloud and mobile, which we showed a few pages back, were the two preceding platform shifts. The infrastructure is really dominated by large tech incumbents. So if you looked at cloud, for example, you see the logos here: Amazon, Azure, which is Microsoft, and then Google. And then all these companies on top of it, they're on this page if they represent $1 billion or more in revenue. So very sizable scale businesses. They all came about after the infrastructure was built. So it wouldn't make sense to have security for an infrastructure tool that doesn't exist yet, or applications need to wait for the infrastructure to be set up before they can be built. So all those companies on top were built, sometimes years after the infrastructure was set up. And then you see the same thing with mobile, where the infrastructure really is Apple, and then maybe Google with their open Android ecosystem. But you also, similar story, see the applications that were built on top of it. Several companies of $1 billion in revenue or more on this page that were startups that were built in the years after. So it's such a white space when you look at AI in comparison. I mean, you have the tech incumbents that have captured a lot of the infrastructure value. So going into the next page, a lot of people will ask, can I just get AI exposure from investing in the big tech giants, the Magnificent Seven, as some people call them? The answer is you can. Part of it is in the infrastructure layer, which accrues to those folks. So what we're showing here is projections of the AI market revenue over time. So we're looking at this is from Bloomberg. We're looking at 2023, which is the left column, and then 2027, and then 2032. So about a 10-year time horizon. And what we say is, looking at the numbers, infrastructure is the dominant category today because it's early days in the artificial intelligence market. So if you had public exposure to NVIDIA or Microsoft has, I think, benefited from this trend as well. You're capturing the value in that category. That's largely going to big tech. But if you look forward 5-10 years, especially, you see that it actually ends up not being the largest category, maybe the largest individual category, but the applications outside of it are actually a bigger share of the market. So it's not growing the fastest. It's just it's the first piece of the puzzle. So that's why it's important to make that distinguish between the infrastructure, which is the first thing to get set up, that goes to the large tech incumbents, and then the applications that get built after that, which largely accrue to startups or early stage companies, and then in turn venture investors. And we think that's where the real opportunity is if you look in a 10-year time frame. And then this is the last AI specific piece, but we're seeing it happen on the ground floor. So we meet with a lot of companies, or managers meet with a lot of AI companies that are spinning out from established tech companies. So what we're showing here is the number of employees who have left some of these established companies to start new projects in AI. And you can see by far and large, they're coming from big tech companies. So Google DeepMind was really the first iteration of generative AI. They wrote the Transformers white paper that got the industry started a handful of years ago. They've seen 36 employees leave to start new companies. Google Brain is another department within Google that's seen 32. One of them is Character AI, which is a kind of AI personalized chatbot that's reached 1 billion. They're on the previous page. And then even OpenAI, which is the leading quote unquote new AI company, has seen some spin outs as well. So Anthropic, for example, is the other leading large language model that's focused on more enterprise use cases, whereas OpenAI they run ChatGPT, which is initially focused on consumer. But the founding team from Anthropic were some of the first engineers at OpenAI. So we're already seeing that second wave of founders coming from AI startups to start new startups. So that flywheel is underway. And then Facebook, as an example, they have developed a couple of models themselves, but then they also had Mistral spin out, which is based in Europe, and that's an open source model as well. So we're starting to see this underway where there's a growing ecosystem of startups that are spinning out from the established tech players, and that's usually the kind of characteristics that you need to have a fruitful startup ecosystem around a new technology. And so we're seeing that underway.
Great. And then, so I think what we're showing on this page here is really that the innovation economy continues to grow, and what we're showing is the digital economy's share of U.S. GDP, so kind of tech share of U.S. GDP. And what's clear is that if you look over the last couple of decades, it's continued to grow, but still remains underpenetrated. So if you look at 2022, it's only at about 10%. But I think the other important point here is that the digital economy is growing at a rate that's almost 2 times the size of that of the U.S. economy, and tech continues to be a growth area. So if you think about venture is an index bet on tech and a way to kind of play that innovation. So if you go to the next page, this growth is also leading to much larger exit markets. So the chart on the left, what we're showing there is the aggregate value of tech companies that have gone public from the 2005 to 2015 decade period, and then the most recent 8-year period. And what you've seen is that the size of that exit market has grown by over 4 times to over $1 trillion. If you look at it on an individual company basis too, the average size of these IPOs is getting bigger as well. So if you look over the same time periods, most recently, businesses are IPOing at an average size of over $3 billion compared to just 800 million in the decades prior. So, companies are getting bigger, they're growing in private markets and continuing to compound. And, if as an investor, you only have public exposure, you're really missing out on a lot of that. And it's why we believe that, having venture within portfolios is important. We can go to the next page as well. If you look at where we are today in the venture market, you see the venture market's weathered a healthy correction, and if history is any guide here, we might be nearing the bottom. So if you looked at prior periods of correction, it typically takes about 9 to 10 quarters to bottom out, and we're almost at that point today. So if you looked at the very far right of this chart, what we're showing there is you're starting to see that the venture dollars invested are starting to flatline, and it's signaling that we're approaching a bottom of this correction period. So there's also plenty of evidence out there to show and point to that in periods post correction you can generate very strong returns in the venture market.
Yeah, bringing it back to the AI discussion here. We looked at the last correction, for example, the Great Recession, pre and post, the vintages pre and post the Great Recession, compared the performance. This is across the venture industry, not just our data, but the post correction vintages were better, whether you're in the top quartile, median, or bottom quartile, than the vintages before the correction. Part of that is what happened in the valuation environment, prices coming down, some similar patterns that we're seeing in the market today. But the other piece was there was a platform shift that happened then, which was the iPhone moment, was sort of late 2000s on the back of the Great Recession. A lot of the startups that end up being the lion's share of returns, and which is usually the case in venture, the biggest companies generate the most returns, were built on the back of the iPhone coming out. And so you had a nice kind of confluence of two events, which was prices coming down and then also having this generational platform shift that created new opportunities. And when you look at where we are today, we see some pattern recognition in terms of valuations coming down, now stabilizing, and then you have this platform shift with artificial intelligence that could lead to strong vintages. And so if you look at where we are today in the venture market, there's really a tale of three situations for companies based on how they're performing. Not every company will be treated the same in this market, and I think that's a shift from the previous five years or so, 10 years maybe, where most companies were able to find funding, continue to compound, get higher valuations. There was a lot of investor appetite. That started to shift where there's a focus on quality and showing strong numbers and continuing to meet expectations. And so the companies that are able to do that are in the left bucket, that first category, which is growing through valuation. So we have actually seen some of the top companies continue to have strong growth rates, prove out profitability. There's been more of a focus on showing unit economics, making sure that your business model is sustainable. And so companies that have been able to prove those things have been able to actually raise at higher valuations than they got in the peak of the market environment, which may be surprising to hear for some, but we've seen several examples of that. We actually have 6 companies in our direct portfolio that are raising up rounds right now because they're able to execute. And then if you see the ones in the second category, the companies that have not been able to maintain strong growth rates or have not been able to make that shift to profitability, which investors now value more, they may be raising down rounds. And so we've seen a handful of those as well, or flat rounds that have some terms on them like structure, but the round itself is flat. Some down rounds as well. So we're starting to see those happen for kind of the other companies that are still viable businesses on their own right, but maybe not the category leading businesses. And then the third category, which we haven't seen as much yet, but will be coming is companies that end up having to find a home somewhere, either selling themselves to another company or eventually shutting down. And those are the companies that are maybe the fourth or fifth or sixth best company in a given space, have not been able to prove profitability, can't be a standalone business, maybe are seeing some headwinds in terms of growth rates. So I think these categories will persist. You'll see companies get any kind of treatment across these based on the quality of the underlying business. But it's important to note that there is still appetite for businesses that are performing well. We're seeing that on the ground now. We usually see these signals from our managers before the broader market knows it, or before the narrative around venture changes. But I think there's reasons for optimism, but it does highly depend on the quality of the businesses now, whereas we're in a time when most companies were able to get funding. That's no longer the case.
And then I think another positive development we're starting to see play out is there's a growing backlog of venture-backed companies that are IPO ready. We're hearing kind of regularly there's a handful that are now starting to confidentially file, and these are companies that have hired the senior executive teams. They've reached a scale where they're at the point where they can start to consider public markets. And if you look at what we witnessed during the pandemic era, was that, a lot of IPOs got pulled forward, and these companies were able to successfully list ahead of when they would have been anticipated to have done so. So that's that 2021 to 2022 period. But since that time, public markets have been a little bit quieter, and we're starting to see some green shoots. Over the last 6 to 12 months, we've seen a number of notable exits, such as the IPOs of Instacart and Reddit. These events in aggregate were worth over $25 million to our funds. And then another recent example was Rubrik, which IPO'd and had very strong public reception. So this is all to say we think that the IPO window is starting to reopen. Another way that we looked at that too, I think PitchBook puts together a list of 20 companies that they see as kind of near-term IPO candidates. And when we look through that list, we have exposure to 13 of 20 of them, which represent over $300 million of value to our funds. So when these companies eventually do go out and do publicly list, expect that to lead to a nice pickup in distribution and liquidity for LPs in our funds.
Yeah, I would say it's hard to predict when the IPO window will reopen, but there are a number of companies that have the characteristics of being a public company. Stripe, for example, is already a category leading company. They're valued at north of 50 billion. They're generating significant revenue and cash flows. So really, the industry, I think, is waiting on one of those preeminent companies, whether it's Stripe or potentially Databricks, which is in the database software space. Very similar company to Snowflake, similar metrics as when Snowflake went public, and at that time that was the biggest software IPO ever. So one of those companies, I think, will reopen the window for everyone else, but it's hard to predict when that'll happen. So that was a bit about AI and the market, and so that naturally kind of dovetails into what we're doing in response to that and how we've set up our program. So I want to spend some time on that, and then we can open it up to questions. But I think a lot of the trends that Cameron and I have been talking about bode well for our strategy. We have a consistent strategy, consistent program. We've been in the market committing to managers for 35 years. Made our first venture investment in 1989. We've been able to always focus on quality. So we have a curated list of managers. Today we're working with about 20 to 25 in any given fund, which is a small subset of the total venture ecosystem, but a lot of them are very long-term relationships. For example, the first manager we committed to was Sequoia, and we're still working with them today. And several relationships are now greater than 20, 30 years in length. And then we've always been focused on performance. So we've committed about $7 billion over that time period. But we've also been able to distribute 8.6 billion over that time, so more than we've committed since inception. That's a stat that we're proud of and try to manage. And then if you look at our performance, we're across all of our 13 mature funds. We just finished committing 14 and raising our 15th today, but the 13 mature ones are all above median in terms of performance across all the different metrics, net multiple, distributions paid in, and IRR as well, above median. And then we're comparing ourselves to other direct managers, so not other fund-to-fund type structures, but direct managers, and we still perform well in comparison. And then we take a very proactive approach to creating our portfolio. So we have what we think are the leading a mix of the leading venture managers, and then some of the newer tier of up and coming managers that we think will be the future established managers. And so that's always been a part of our program. We'll talk about what our manager list looks like today and some of the adjustments we've made in a couple slides, but generally working with access constrained managers that have consistently shown top quartile type performance. There's a persistence of returns in venture that you don't see as much in other asset classes. The top venture firms tend to see the best deals. The best founders want to work with them because they've helped other companies succeed. So there is a bit of a reputational advantage to being in that top tier that we've seen play out over time. And then we have very deep relationships with those managers too. So we sit on 20 or more advisory boards across our team, which is almost the entire coverage of the managers we work with. And I mentioned the length of these relationships. We're deeply embedded. And so if you look at our managers, we think they're well positioned to take advantage of the trends in AI. Sometimes we get asked if we work with new sector specialists, for example. That has not been our approach through past platform shifts, and we think that's prudent again. One of the things that is important to note about AI in particular is it's not a new sector so much as it's going to permeate existing sectors. So if you think about enterprise businesses or healthcare businesses, they'll have an AI strategy. They'll be employing AI in their workflows, in the way they interact with their customers or patients. So we think it's important to have a broad understanding of those industries. And so the managers that have large amounts of companies in those spaces will be best positioned to take advantage of these trends and figure out the right way the AI will be used and commercialized. So we're continuing to have conviction in our generalist managers that have big portfolios across different sectors. So you see some of them listed here. Some of the largest commitments that we have cycle to cycle are in Excel, Andreessen Horowitz, and Sequoia, which have broad global portfolio companies and teams. We think they're well positioned. And then we have several other high conviction names that are access constrained, which you can see on the right. And then collectively that ends up being the majority of the allocations that we commit in each cycle. So that gives you a sense for kind of the pipeline going into this fund. We think these are all well positioned managers to take advantage of AI. And then the other piece of it is a long tail of about 20% of our capital goes to new relationships where we think that they have something special, a secret sauce that is a little bit differentiated, that could be accretive to our performance of our fund. So we're constantly evaluating who to add as well, but we do have a high bar and try to keep that kind of 25-ish manager roster over time. So this is what we have done so far in our Fund 15. As I mentioned, this is the one that we're actively raising, and we've actually started to commit it into some exciting managers and companies. So we're targeting 600 million, which is actually a little bit lower than what we did last cycle. We want to be disciplined, keep the same set of managers, not necessarily expand for the sake of growing assets, focus on net returns. So 600 million target, we're more than halfway to that goal as of today. And we have started committing it. So we started making commitments in Q1 of this year. So we've backed 2 managers so far, Excel and Andreessen Horowitz, both of which are long-term partners of ours. And then index as well is the most recently added one. So 3 managers total, and then we have invested in a few secondaries, which are kind of attractively priced LP interests in some of our existing managers, where we had a good perspective on the portfolio, thought it was undervalued at that discount, and so that helps us kind of show some early performance in the fund, which reduces the negative IRR at the beginning, the J curve, and they're attractively priced in this market. So pretty happy with those. And then we've made 3 direct investments as well. Direct investing is about 15% of our total portfolio in each fund. And a couple of the names here you might recognize if you are following the AI space. So Anthropic, which I touched on a bit earlier, is the enterprise grade large language model. So that spun out from OpenAI. The team was focused on building a model that has better hallucination, so it gives you more accurate results over time. It is a little bit more sophisticated than some of the models that that OpenAI puts out for consumer use. So we thought that was a good way to approach the market by backing the other leading closed source large language model that is expected to kind of be a category leader. And then we also backed Hugging Face, which is the leading open source approach to AI. So essentially Hugging Face is like GitHub, if you're familiar with GitHub, but basically a community, online community that stores different models. So if you're a developer at an enterprise or just want to find a model that's publicly available to use for something, you can go to Hugging Face, pull it down. You can also make changes to it and updates to make it better, and then put it back into Hugging Face. So it has this strong kind of developer community. It constantly iterates on itself as a good source of innovation. And we've seen in past platform shifts that closed systems and open systems both kind of coalesce and grow together. If you think about like the iPhone, which is closed, and then Google's Android market, which is open, both of them have kind of grown at the same time and played off each other and are both important for innovation. So we think something similar will happen with AI. So we backed the leading players in both of those. And then we backed another company called Exotech, which is in the next gen robotics space. So it has a bit of an AI piece to it as well, where they're working with retailers to automate warehouses. So if you order something from one of their customers, that warehouse will be fitted with Exotech robots that go and pick your inventory that you ordered and package it and then ship it off to the right place, all without human intervention. So you can think about the way that saves costs, as Cameron was talking about before, one of the key value adds of this technology. Amazon has their own solution for this, so Exotech is really meant for retailers to help compete with Amazon and offer similar pricing and then same day delivery as well. So we've made some commitments that we're excited about. We aren't expecting to call capital until later in the year. But again, to reiterate the bottom right here, we've been very consistent with our strategy over time, and we think that it plays well into some of the trends we're seeing. So this will be predominantly US and Europe. We have some exposure elsewhere as well, but primarily a US and Europe fund. We think a lot of the AI innovation is coming from those regions. Diversified investment themes. So we obviously talked about AI a lot, but we're investing across enterprise, healthcare, technologies, consumer, fintech. AI will permeate all of those, blockchain as well. And then working with access constrained managers that have seen multiple cycles, up and down cycles, so they're well positioned during a tumultuous venture market to give the right advice to founders and find the right quality companies that will be those category leaders that continue to grow during uncertain times. I think we can probably take questions. I wanted to leave some time. It's 15 minutes. Unless, Cameron, you have anything to add?
Yeah, no, I think that covered it.
Just a quick reminder to everybody in the audience that there's a button at the top of the screen, P&R, preguntas y respuestas, just in case you guys want to add questions for the CF private equity team. And maybe I will kick off. You commented a lot about the Fund 15. Are you backing specialist investors, or because those names that you have on the screen are large players and broadly diversified? So is it that the tonic, or you also back, I don't know, AI specialists given the fund?
Yeah, I can take that. So this is a list of our managers, which is maybe a good reference. So they're on here if they're an active commitment of ours to their most recent fund. The audience may recognize most of these names, maybe not all of them, but we do have a bias towards backing generalist managers, and we've done that over multiple cycles. We think the generalist managers are the best positioned to kind of be more flexible when there is an opportunity versus being more prescriptive. So, for example, we decided not to back any fintech specific managers over the last 10 years, even though many of them are doing very well, because it's hard for them to pivot when the sector that they're focused in goes through a rough patch, as we've seen recently. So we have generalist managers. I would say within these managers, there are individual general partners who have sector domain expertise. And so they're pretty well positioned to make adjustments as sectors become more or less attractive to them. And so we really trust our managers to help make those decisions on our behalf. Again, if you think about artificial intelligence, it's really a piece of what's happening across a lot of different sectors. So, we view it as a platform shift that will accelerate growth in enterprise software, accelerate growth in healthcare technologies, accelerate growth in fintech. So we think that the managers that are covering all of those spaces are likely to do well. It's a little bit different in blockchain, for example, where that is really a new technology that operates a little bit differently, and you need to have. We think that for managers to be successful, you need to have a deep engineering team. You need to be native to that space, really understand the protocols that are being built. In artificial intelligence, the distribution is pretty similar in the sense that you can access AI applications on your phone or through a browser on your phone or desktop, and often you don't even know you're interacting with AI as the end consumer. So it's a little bit different in terms of how it actually looks. It is a new platform shift, but it's not necessarily a new behavior. So we think that the companies that have had success in the past with other platforms are likely to succeed with AI as well. So that's why we've kind of gotten more conviction, if anything, in our generalist approach with this platform shift that's happening.
Perfect. We got a question here regarding you showed that map of the different subsectors and AI being at the bottom with the infrastructure and going up until applications, and you have some blanks, especially security, and I remember data and data. Do you think that the opportunity is actually to fill the blanks, or still have a lot of room to grow? Well, infra you mentioned are probably the large caps, but in terms of apps or developers.
Yeah, I think it's both. Infra has been the initial piece. So basically, if you've read or heard anything about AI, everyone's really talking about the infrastructure layer today. Some of them have. One in particular, OpenAI has verticalized, where they have infrastructure through application, where individual person can interact with it, but they actually own the model that's powering it. So I think a couple of different ways to answer that is infrastructure will continue to grow still. It's, again, if you go back to one of the other pages, it's so early in the development of AI that all of this is really new and small compared to what it can be. So I think there's a lot of growth to come in infrastructure layer. I would say the caveat there is it is capital intensive. So if you're a startup without deep pockets, you probably aren't going to try to compete or want to compete in that space. Most of the infrastructure companies have partnerships with big tech companies. So OpenAI, for example, has a partnership with Microsoft. Anthropic has a partnership with Amazon and Google. So that's where the capital is coming from to continue to build, to train these models and make them better and better. That cost will go down over time. We can get into why that's the case. But suffice to say that the big companies that have a lot of money will be playing in that space. But then the point is here that there's a huge white space in all the other things. So yeah, as you pointed out, security and data management, there aren't any companies that are at that billion threshold yet. But that's a space where there will probably be multiple winners, which we saw in mobile and cloud. And then same with developer communities, and then finally applications, which actually ends up being where most of the billion plus startups end up being formed, as you can see on the page. We think that the AI box that only has 3 logos today will look more like that, but it'll take probably 10 years to get there. But now is when those companies, now and over the next couple of years, when those generative AI applications will be founded, which is, if you wanted exposure to those, which is why you would have a venture exposure to get into those early. And then the last piece I would say is we think there's going to be a verticalization too. So there might be some companies that have a bit of all of these layers, but with a very industry specific application. So if you think about healthcare, for example, there's a lot of considerations with healthcare in terms of regulation, working with a lot of different types of stakeholders. You probably can't use an open source public model as easily as you can for something like a customer service chatbot, which is a lot less sensitive. So you might see that kind of industry have its own solution, vertical specific solution, in which case there could be a company that cuts across a lot of these different layers. So we think that the growth is going to come from that, and then also from just general applications like a Salesforce that is kind of, it's what we call horizontal. It sells to, doesn't matter what industry you're in, you could use it. So we see that kind of thing play out as well. But yeah, there's obviously a lot of room to grow looking at this page.
Perfect. And maybe one last question is, well, I think maybe you touched it with the comments recently, but do you see the opportunity more biased to early stage, late stage, of course, leaving the public and the mega caps out of the picture?
Yeah, Cameron, do you want to take that? I can chime in. You're on mute.
I still think there isn't all that much of a late stage market yet. I think, as just underscoring what Dave said throughout the presentation, this still is a very early space, and you have seen a couple of companies grow into large valuations like Anthropic's and OpenAI's, but I think the more attractive opportunity set now that we have these kind of foundational models is the applications that will be built around them and on top of them, and that stuff is still all very new, and the space is emerging. So I think for the time being, right, the very early stage opportunity set is where our managers are focusing in on.
Yeah, I would say AI has gone through an evolution even over the last 10 years or so. So some of the late stage AI companies are more like computer vision or natural language processing companies that aren't generative AI. So generative is different because it's actually creating something, whether it's text or images or video, code even. So that layer is really where most of the promise is and the economic potential. And that's, as Cameron said, all early stage today. Those companies are just being founded, or most of the winners we think probably aren't even founded yet. So that's why it's early stage is the way to capture that. But AI has been talked about for a while. But if you look at some of the later stage companies that are saying that they're doing AI, it might be maybe a more rudimentary version like computer vision or NLP. So it's a little bit different. But we think we think that the true AI that's kind of gotten this hype cycle that's really being focused on today is early stage.
Perfect. Perfect. Thank you, guys. Just in respect of time, I think we're going to wrap it up. We want to thank you, the three of you at CF Private Equity, for joining us. And of course, to all our clients and prospects that joined the meeting. It was really insightful, really helpful. We hear a lot about AI, but sometimes it's good to have a little bit of landing of the concepts. As the team mentioned, Fund 15 is on fundraising process. Please, if this is something that is on your interest, let us know. We will put you in contact with Daniel and the CF Private Equity team. We think it's a great opportunity to be exposed with a manager that has a lot of experience regarding this type of investment. So makes a lot of sense. So from our end, we want to thank you all for joining. Thank you, Daniel. Thank you, Dave. And thank you, Cameron, for the time. And we'll be in touch. Muchas gracias a todos.
Muchas gracias. Chau, chau
Thank
a
you.
todos. Chau. Bye, everyone.
Bye-bye.
Chau.